Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest instalment of our Through the Noise mini-series to discuss our Q3 global market outlook, navigating a difficult near-term outlook. Today I want to talk in a little bit more detail about our equity market outlook. We've been reducing our allocation to equities as we've gone through this year, as we get more and more concerned about the risk of a recession and in the US and in Europe. And obviously I talked to Rajat about that last week. To explore the implications of this for global equity markets, I have with me today Fook Hien. We will discuss the outlook for equity markets as a whole, as well as our regional and sector preferences. So Fook Hien, let's get started. So obviously we've seen a bear market in global equities. So bear market defined as over 20%, we're down over 25% from the peak now. Can you give us a sense of the direction in global equities you're expecting from here?
Yeah, thanks, Steve. We continue to see global equities as a core holding on a 12-month horizon. Okay, however, on a shorter 3-month basis, we are cautious that equities may take another leg lower. And a big driver for this is that rate hikes, we believe, will be front-loaded in coming months. Now, the market has already fallen more than 25%, as you say, which arguably means a shallow recession is priced in. But the Fed remains aggressively focused on controlling inflation. And there is risk that policy is tightened to the point where a recession is no longer shallow. Hence, we're cautious in the near term with aggressive rate hikes expected. However, on a 12-month horizon, we can see global equities going up. That's because our central scenario is that inflation will peak and start to fall gradually by the end of the year. That means the Fed could hike rates up to the 4.5% that markets expect or less. And once we see the Fed pause in their rate hikes, this will give global equities more breathing room. So in our central scenario, we do see global equities going up over 12 months, and it's a core holding. The volatility would likely be elevated.
Okay, so from a regional perspective, we continue to be overweight Asia ex-Japan. That's obviously not worked at all for us in the third quarter. What is your thinking about the overweight call from here?
Yeah, you're right. I mean, performance has been disappointing in Q3, and a large reason has been China equities performance, where zero COVID policy has led to uneven economic growth. So we have downgraded China equities now to perform in line within Asia ex-Japan. And India is our most preferred country within Asia ex-Japan. But we still do have a preferred view on Asia ex-Japan region compared to global equities. The starting point of valuation is still relatively inexpensive. And in China, we do expect the government to refocus their energy on stimulating the economy after the Party Congress in October or later this month. And this should support earnings growth in Asia ex-Japan to rebound in 2023. In fact, among the major regions, Asia ex-Japan has the highest projected EPS growth in 2023. Now, we do see a stronger US dollar in the next 3 months, which is a headwind for Asia ex-Japan, but this is a 3-month risk. Over 12 months, we have a neutral view on the US dollar, so we don't see it dragging on Asia ex-Japan performance over 12 months.
Okay, so outside of Asia ex-Japan, do you have any other regional preferences?
Yes, regionally, UK equities is also a preferred holding. This is based on its attractive dividend yield compared to global equities. The valuation is at its deepest discount in 20 years. And the large cap UK companies derive more than 70% of their revenues from overseas. This means their earnings will benefit from the weaker pound, though we do add a FX hedge to our UK equities exposure to mitigate the risk of FX volatility. So apart from our two preferred regions of Asia ex-Japan and the UK, we also have a core view of the US and Japan. We expect these two regions to perform in line with global equities over the next 12 months. And we have a less preferred view of the Euro area, where we see it underperforming global equities. The energy prices there due to the Russia-Ukraine conflict is causing a lot of uncertainty, which is bad for consumer sentiment. And with a growth slowdown, this brings downside risk to their earnings.
Okay, so let's talk about sectors. Obviously, you chair the Sector Investment Committee within the CIO office. So can you give us a sense of what are your preferred sectors and what's the rationale behind those views?
Yeah, our sector views now are overall rather cautious. Energy is the clear preferred sector globally in the US, Europe, and China. And energy has done well this year, and we think this can continue with more focus on energy independence. We see government policies turning more supportive of energy investments, even amid the green transition we have. And the oil and gas producers overall, they remain disciplined on cost and capex, so they're generating strong cash flows to strengthen their balance sheet or reward shareholders. So earnings growth has been very strong in the energy sector, and consensus is expecting earnings to fall in 2023 from the high base this year. But we believe the current depressed valuation more than makes up for this. Essentially, energy equities have yet to catch up with the strong earnings performance. And more specific to China, actually, the energy sector there also has coal exposure, and we're seeing strong coal demand there from the power plants as the hydropower stations face a drought and there's a gap in energy supply. So apart from energy in the US, we also like healthcare that gives a steady earnings growth and defensive exposure in a volatile market. And in Europe, we also like the financial sector. Valuation there continues to be very attractive. It's at the bottom of its historic range despite rising interest rates that should support higher interest income for the banks, and arguably the sector should re-rate higher. We believe the banks have strong capital positions that can protect the banking system from risk with the Ukraine war or other idiosyncratic risks.
Okay, thanks, Fook Hien, for your insights. Certainly looks like a challenging environment, and investors need to balance the highly uncertain short-term equity market outlook and indeed the macroeconomic outlook with the fact that valuations have already corrected significantly. Therefore, I guess having a core allocation to equities still makes sense. Thank you, listener, for joining us as well. I hope you found it useful as you continue on your investment journey. Should you need more information, please do not hesitate to take a look at our Wealth Insights page on LinkedIn. In the meantime, please take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.